And it's good to see you. Just off that stat that Julia just brought us, that from Moody's Analytics, that the American household is spending $433 more this month on goods and services because of inflation. How's that going to impact holiday spending?
Yeah, thanks, Sarah. Great to see you. Inflation is definitely putting a crunch on the consumer's budget, and so we think there's some consumer cohorts, the higher income cohort, that's positioned to do particularly well and keep categories like the luxury category chugging along. But we think the middle end and the low end consumers just under a tremendous amount of stress and having to make very hard choices and prioritize needs over wants. So that favors companies like TJX that offer great value, or Walmart that's selling stuff folks absolutely need.
I'm looking at your top holdings. You also have Home Depot in here, which I don't know, that gets caught up in the whole mortgage rate shock that we've seen, and some of the other problems. DraftKings is in here as well, so it's not all necessarily fitting in with that theme. Talk us through some of those picks.
Yeah, it's not all defensive. We think that the biggest opportunity we see in the idea behind the next generation connected consumer fund, it's a multi-decade runway. So we certainly think over the course of years, if we get exposure to the right areas that these up and coming generations, Gen Y and Gen Z, that they favor, that they're going to areas that they're going to continue to spend more on. We think over multi-years this can generate really attractive risk-adjusted returns. So Home Depot is a name that fits in great. Home improvement, for starters, is a bit more resilient than the broader housing complex, but Home Depot also just does a phenomenal job capturing new homeowners who are just entering into the category.
Got it. So that's a longer-term play. Back to what's happening now, John. You say you like luxury and that it holds up in this environment. What stocks are your favorite in that space?
Sure. So Montclair is the luxury goods brand that we own. We do a ton of work, analyze a ton of data around how consumers view the brand and the scarcity and the value of the brand, and all of that work really checks out off the charts that this is a beloved brand that has a lot of pricing power. They have a clientele that's in a better position to deal with elevated gas prices and elevated food prices and still have some budget left over for discretionary spending. So we think a great consumer there. Farfetch is another one that's a super controversial name where results have disappointed in 2022, but we feel like the worst might be behind us there, and Farfetch as the leading online luxury destination is positioned really well as the category moves online to generate a ton of growth in the years ahead and see great dramatic improvement in their profitability as well.
I was going to ask about profitability for the entire sector, because all we hear about is that it's going to be more promotional, higher inventories, supply chain is thawing, so we're going to see promos, and we're already starting to see some deep discounts, and a lot of them started early. So, John, how do you worry about the sector maintaining profitability?
Absolutely. That's a great question. I think discounts are already running a little bit hotter today as we sit here today. I suspect by the time we get to the end of holiday season, if consumers continue to kind of wait around and purchase closer to need, I think promotions will be running white hot. So in the categories where there's way too much supply out there, like big ticket and certain home related categories, we would expect margins to remain under a tremendous amount of pressure. But as we look out through next year, there's some cost inflation that will start to roll off, particularly freight, and the inventory outlook should be much better for next year. So we think we could have a bounce back in margins once we get through this holiday season.
Who's got the best pricing? Who's in the better position? Is it the luxury players who still have the pricing power in this environment?
We sort of view the world, we view our portfolio kind of on a barbell continuum. And so the luxury good names, I don't want to say they're immune from all the consumer distress today, but they're relatively insulated. So that's a good place to be. We also think there are retailers that actually could benefit from consumer distress. I mean, we own Dollar Tree in the portfolio. We own Walmart in the portfolio. TJX is a name I flagged earlier. These are places where when the consumer's trying to stretch the dollar a little bit further, they can do so in a dollar store or at a Walmart. So we think both ends of the continuum will generate some winners.